All right, moving right along. So things are going to start getting a bit more fun. We're going to start moving into a lot more charting and a lot more technical analysis. So I hope you're ready. This next lesson is going to be on the mechanics of oscillators and divergence. Now, I want to discuss the concept of divergence before we move into discussing these indicators and oscillators in depth, and you may actually have to come back and review this video after we go through the indicators in much more depth. It's good to have a grasp of what exactly divergence is before we start speaking about how to use these indicators to help determine and forecast price action. Okay, so what is an oscillator? So an oscillator is a technical analysis tool that constructs high and low bands between two extreme values and then builds a trend indicator that fluctuates within these bounds. Now, traders use trend indicators to discover short-term overbought or oversold conditions. Now, when the value of the oscillator approaches the upper extreme value, typically around 100 or 1, technical analysts interpret the information to mean that the asset is overbought, and as it approaches the lower extreme, usually 0 or 1, technicians consider the asset to be oversold. Now, oscillators are momentum indicators used in TA whose fluctuations are bound by some upper and lower bands. When oscillator values approach these bands, they provide overbought or oversold signals to traders. Oscillators are often combined with moving average indicators to signal trend breakouts and or reversals. Now, some popular oscillators that you may have heard of are 1, obviously, the relative strength index, 2, the stochastic relative strength index, 3, the money flow index, or on balance volume. We will go through the top 2 of these in depth in this course. So the mechanics of an oscillator. So in TA, an investor measures oscillators on a percentage scale from 0 to 100, where the closing price is relative to the total price range for a specified number of bars in a given bar chart. Now, in order to achieve this, one deploys various techniques of manipulating and smoothing out multiple moving averages. When the market trades in a specific range, the oscillator follows the price fluctuations and indicates an overbought condition when it exceeds 70 to 80% of the specified total price range, signifying a sell opportunity. An oversold condition exists when the oscillator falls below 30 to 20%, which signifies a buy opportunity. Now, the signals remain valid as long as the price of the underlying security or asset remains in the established range. However, when a price breakout occurs, the signals may be misleading. Analysts consider a price breakout either the resetting of the range by which the current sideways market is bound or the beginning of a brand new trend. Now, during the price breakout, the oscillator may remain in the overbought or oversold range for an extended period of time. We've seen this with Bitcoin, especially over the past few months. As we've been in a parabolic rally to the upside, we've seen the RSI pinned above 90 almost the entire time. Now, technical analysts consider oscillators better suited for sideways markets and consider them much more effective when used in conjunction with a technical indicator that identifies the market as being in a trend or range bound. All right, so extremely important section of this course. We are now about to go through divergences. So what are divergences, or what is divergence? Divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or is moving contrary to other data. Now, divergence warns that the current price trend may be weakening, and in some cases it may lead to the price changing direction. Now, there is positive and there is negative divergence. We commonly refer to these as bullish and bearish divergence. Now, positive or bullish divergence indicates a move higher in the price of an asset is possible. Now, negative or bearish divergence indicates that a move lower in the asset is possible. What does divergence tell you? Now, divergence in TA may signal a major positive or a major negative move. A positive or bullish bullish divergence occurs when the price of an asset makes a new low while an indicator such as the RSI starts to climb. Now, conversely, a negative or bearish divergence is when the price makes a new high, but the indicator being analyzed makes a brand new lower high. Now, traders use divergence to assess the underlying momentum in the price of an asset and for assessing the likelihood of a price reversal. For example, investors can plot oscillators like the RSI on a price chart. If the price of the asset is rising and making new highs, ideally the RSI is reaching new highs as well. If the asset is making new highs but the RSI starts making lower highs, this warns that the price trend may be weakening. This is negative or bearish divergence. The trader can then determine if they want to exit the position or set a stop loss in case the price does start to decline. Now, positive or bullish divergence is the exact opposite. Imagine the price of a stock or a crypto that is making new lows while the RSI makes higher lows with each swing in the price. Investors may conclude that the lower lows in the price are losing their downward momentum and a trend reversal may soon follow. Divergence is one of the most common uses of technical indicators and primarily the use for oscillators. Now, divergence can occur between the price of an asset and almost any technical, fundamental indicator or data. Though divergence is typically used by technical traders when the price is moving in the opposite direction of a technical indicator. Positive or bullish divergence signals could start moving higher soon. It occurs when the price is moving lower, but a technical indicator is moving higher or showing bullish signals. Now, negative, again, or bearish divergence points to lower prices in the future. It occurs when the price is moving higher, but a technical indicator is moving lower or showing bearish signals. Divergence isn't to be relied on exclusively, as it doesn't provide timely trade signals. Divergence can last a long time without a price reversal occurring. We can see this here very clearly when we look at the S&P 500. Now, divergence is not present for all major price reversals and is only present on some. Divergence is either positive bullish or negative bearish. Now, there are two types of basic divergences. You have your regular, which indicates towards trend reversal. You have your hidden, which indicates toward trend continuation. Now, divergence signals tend to be more accurate on higher time frames. You get less false signals. Now, this means fewer trades, but if you structure your trades well, then your profit potentially can be huge. Divergences on shorter time frames will occur more frequently, but are typically much less reliable. Now, let's take a look at regular bullish divergence. Now, the regular divergence here is indicative of a trend reversal. We're looking for bullish divergences and downtrends. This indicates underlying strength, the bears are exhausted, and it's warning of a possible trend direction change from downward to upward. All right, here's an example of regular bearish divergence. Now, regular divergence is indicative, again, of trend reversal. We're looking for bearish divergences on uptrends. This indicates underlying weakness. The bulls are exhausted, warning of a possible trend direction change. Okay, so moving on to hidden divergences. Here's an example of hidden bullish divergence. This is indicative of trend continuation. So you want to look for hidden bullish divergence in uptrends. This indicates underlying strength and that the bulls are in control. You'll see higher lows in price action with lower lows in the oscillator. Okay, here's an example of hidden bearish divergence. Now, hidden bearish divergence does indicate trend continuation. So you're looking for hidden bearish divergences in downtrends. This indicates underlying weakness in the price and the bears are in control. So you see higher highs in the oscillator and lower highs in price action. Okay. Another form of divergence that we haven't really discussed yet, but it's important for you to know, is exaggerated divergence. Now, it's formed when price makes a double top or a double bottom rather than a new high or low. Now, the logic behind exaggerated divergences is that sometimes the indicators show hidden tendencies of the market, whether strength or weakness, that might not be visible in the price action just yet. So we'll see a double top, and then we will see, if it's bearish divergence, we'll see a high and a lower high. If it's exaggerated bullish divergence, we will see a double bottom with a low in the oscillator and a higher low with the double bottom in the bullish exaggerated divergence. Now, divergence versus confirmation. So divergence is when the price and the indicator are telling the trader two different things. Confirmation is when the indicator and price, or multiple indicators, are telling the trader the same thing. Now, ideally, traders want confirmation to enter trades and while in trades. If the price is moving up, they want their indicators to signal that the price move is likely to continue. Now, there are some limitations of divergence. Now, as it's true with all forms of technical analysis, investors should use a combination of indicators and analysis techniques to confirm a trend reversal before acting on divergence alone. Let me say that again. Investors should use a combination of indicators and analysis techniques to confirm a trend reversal before acting on divergence alone. Divergence will not be present in all price reversals. Therefore, some other form of risk control or analysis needs to be used in conjunction with divergence. Also, when divergence does occur, it doesn't mean that the price will reverse or that a reversal will occur soon. Divergence can last a long time, so acting on it alone could mean substantial losses if the price doesn't react as expected. All right, guys, so that is the lesson on divergence, and we did briefly discuss what oscillators are. I hope you're able to come away with an understanding, because as we move forward in this course, having a firm grasp of the concept of divergence is going to be extremely important, especially in your technical analysis as you move in your trading career.